After markets post big quarterly losses, are buffered ETFs the way to go? Well, buffered ETFs or defined outcome ETFs are funds that offer the investor some level of the upside of an asset, while at the same time give you some protection from the downside. The largest one out there, the FTVest Laddered Buffer ETF, is down this year, though it has outperformed the wider market. So is now the right time to look at buffered ETFs? Well, Mike Loukas is CEO of TrueMark Investments. Mike, let's get to it and start with that question. Is now the right time to invest? And are you seeing a growing interest in buffered ETFs this year?
Well, let me take the latter half of that question first. We've seen a massive uptick in buffered ETFs this year. It's akin to going all the way back to the pandemic when I think the segment first really started to explode. When you see these volatility storms, when you see a lot of uncertainty in the market, we see investors and their advisors alike flock to these types of products. Is it the right time for these? Well, let me say there's no wrong time for these, right? And I know that sounds a little hokey because, it sounds like a sales pitch, but the reality is that there's so many types of defined outcome or buffered products in the market right now. They all do different things. And by and large, I like to say they're math-based. Therefore, they all should work depending on what you're looking for. So it really is about matching the investor's objective with the actual objective of the buffered ETF or the defined outcome product. So there's no wrong time for these, provided that you're matching them up correctly with your market outlook.
But Mike, is there a danger that the market volatility that we're seeing right now is only going to last for a short while and that long-term investors would be better off investing in something more traditional?
We've seen that argument quite a bit lately, and generally it comes from the side of the fence that prefers the long-only, long-term investing, and that's what this is, right? So let's not forget that this really is equity exposure in most cases. And depending on the type of approach you use, one of the things we stress here at TrueShares is the idea that if you're ascertaining equity exposure, you don't want to lose the characteristics or the growth characteristics of that equity exposure. So how do we address both sides of the volatility spectrum, right? The left tail and the right tail. And I think that's important to remember. I think that is at the crux of this discussion, which is, can you manage volatility and at least do an adequate job of capturing upside while mitigating the downside? There's no free lunch in hedging. We know that. And I think that's the other thing to remember. When you compare long-term performance of SPY, for example, certainly you'll have to look at a very wide lens to understand the long-term benefits or the compounding benefits of mitigating downside while capturing upside. But head-to-head, there's no hedging process that's going to capture 100% of the upside all the way, unlimited.
Now, I know that you run a number of ETFs. I mean, how do they differ from the rest in the buffered ETF market? And how well have they performed this year so far?
Yeah, so building off of, what we just discussed, we take a little bit of a different approach than most of our peers. And if you had to put it in a silo, I'd say we have a more bullish approach than most of our peers in the buffered space. So we pursue a typical downside buffer, but we pursue what's called a percentage or an upside capture on large cap equities over the course of the investment period. So we don't focus on the one-to-one to a cap. We focus on providing a percentage upside capture to an unlimited level over the course of the investment period. For example, one of our buffered products just reset the portfolio yesterday, and that's our April series, APRZ. And that came out with 82 to 84% upside capture over the next 12 months with a 10% downside buffer. So as you can imagine, we think a 10% downside buffer is really kind of a sweet spot. It allows for normal to medium and sometimes extreme market volatility. But at the same time, you have that 82 to 84% upside capture of the large cap equity market over the next 12 months. And that allows for a fairly bullish stance, and in that case, if the market booms, because we believe in chunky returns, right? We believe in chunky returns, not sequential returns, because it's just not pretty in the market sometimes. And if you get those chunky upside returns, we try and capture as much of that as possible, because capturing that right side of the good volatility is just as important as mitigating that left side tail, which is the bad volatility. And we always have to keep that in mind.
That was Mike Loukas from TrueMark Investments. And that was your look at Buffett ETFs. I'm Ramzan Karmali, and this is Reuters.